You just finished your best year freelancing. $92,000 in 1099 income, no boss, no withholding, nobody taking a cut before it hits your checking account. Then April comes and you owe about $21,000 all at once, plus a penalty you didn't even know existed, because the IRS wanted that money in 4 pieces spread across the year and you sent it in one. That penalty isn't a flat fee, by the way. The IRS sets the underpayment interest rate quarterly under IRC Section 6621, federal short-term rate plus 3 points. And for individuals, it sat at 7% through recent 2025 quarters. 7% compounding daily on money you technically already earned. So how much are you actually supposed to send and when? That's the part nobody explains, and the answer is a formula you can run in about 10 minutes once you see it. Let's build it from the ground up, because the order matters here. The first thing to understand is that you're paying 2 completely different taxes at the same time, and lumping them together is why people guess wrong. There's income tax, which you already know about from your W-2 days, and there's self-employment tax, which is the one that ambushes people. Per the IRS, self-employment tax runs 15.3%, 12.4% for Social Security, and 2.9% for Medicare. And here's the part that stings. As an employee, your employer paid half of that. Now you're both halves. You're the employer and the employee. Congratulations. The mug's in the mail. But there's a wrinkle that works in your favor. That 15.3% doesn't apply to your full profit. It applies to 92.35% of your net self-employment earnings calculated on Schedule SE. So if your net profit after expenses is $80,000, the number that goes into the SE tax calculation is $73,880. That's 92.35% of $80,000. Multiply that by 15.3%, and your self-employment tax is roughly $11,304. The Social Security piece has a ceiling. For 2026, the Social Security taxable wage base is $184,500 per the SSA fact sheet, so the 12.4% portion stops once your earnings base hits that. Medicare's 2.9% keeps going forever. No cap. And if your self-employment income clears $200,000 single or $250,000 married filing jointly, an extra 0.9% additional Medicare tax kicks in on top. And those thresholds are not indexed to inflation, so they've been the same numbers for years and will quietly catch more people every year. If you're a high earner, or you and your spouse both freelance, that 0.9% is real money, and your filing status changes exactly where it starts. Now, income tax. This is where the second wrinkle helps you. 1/2 of your self-employment tax is deductible above the line on Schedule 1. So in that $80,000 example, you knock about $5,652 off your income before the regular income tax math even starts. Then your standard deduction comes off. And if you're using 2025 as your baseline year, that was $15,000 single and $30,000 married, filing jointly per Revenue Procedure 2440, with the 2026 versions adjusted upward for inflation. Whatever's left runs through the brackets. One thing worth knowing about those brackets, the One Big Beautiful Bill Act, signed July 4th, 2025, made the Tax Cuts and Jobs Act, rate structure, and the bigger standard deduction permanent. They'd been scheduled to sunset. They didn't. That matters for you specifically because it means your prior year tax number, the one we're about to use, isn't sitting on a cliff. Which brings me to the single most useful thing in this entire video. You do not have to predict your income accurately. Let me say that again, because freelancers torture themselves trying to forecast a year that hasn't happened yet. The IRS gives you a safe harbor. Under Topic 306, you avoid the underpayment penalty if your withholding plus timely estimated payments cover the smaller of 90% of this year's tax or 100% of last year's total tax liability. If your prior year adjusted gross income was over $150,000, or $75,000 if you're married filing separately, that second number goes up to 110%. Here's what I do, and it's what I actually do. Use the prior year number. Pull up last year's Form 1040, find your total tax by not what you owed in April, not your refund. Your total tax line, divide by 4 and pay that 4 times. Done. If your AGI was over $150,000, multiply by 1.1 first. That's the whole calculation. Say your total tax last year was $18,400 and your AGI was $110,000. Divide $18,400 by 4, and you're sending $4,600 per payment. If you have a monster year and end up owing $31,000, you'll write a check in April for the difference, but you won't owe a penalty because you hit the harbor. My take is that the certainty is worth more than the optimization. A lot of freelancers chase the 90% of current year route because it can mean smaller payments in a down year. And honestly, it's the right call if your income genuinely dropped. If you made $140,000 last year and you're on pace for $70,000 this year, don't send payments sized for a year you're not having. But you need clean bookkeeping to defend that number, and most people don't have it. One caveat before you set it and forget it: if you're a first-year freelancer, there is no prior year of self-employment to lean on. In that case, you're estimating current year tax, and I'd set aside 30% of every payment that lands. That's a working rule, not a statute. And your actual rate depends on your bracket, your state, and how much you can deduct. Okay, so you've got your number. Now, when? The due dates are April 15th, June 15th, September 15th, and January 15th of the following year. That's straight from the IRS Estimated Tax FAQ, and notice what's weird about it. Those are not quarters. April to June is 2 months. September to January is 4. The IRS calls them payment periods, and they cover unequal 3-month windows that don't line up with the calendar the way your brain wants them to. So if you're budgeting monthly and thinking, I'll save up over the next 3 months for the June payment, you've got 2 months, not 3. That June one catches everybody the first year. Paying is genuinely easy, which is the one nice thing I'll say about the IRS this whole video. Go to irs.gov. Use direct pay, choose estimated tax, pick the right tax year. And please pick the right tax year because applying a 2026 payment to 2025 creates a paperwork mess that takes months to unwind. Enter your bank info and you're out in 4 minutes. No account, no fee. There's also EFTPS, which requires enrollment and a PIN mailed to you, and I like it because it keeps a permanent payment history you can pull up years later. Card payments work too, but the processors charge roughly 1.75% to 2%. So on a $4,600 payment, that's about $85 to hand over for nothing. Don't. Now the belief I want to kill because it costs people real money. If you get a refund when you file, you can't owe an underpayment penalty. Right? Wrong. The estimated tax penalty is calculated per period on Form 2210, which means you can skip your April payment, make a giant catch-up payment in September, end the year with a refund coming to you, and still owe a penalty for the months your April money was late. The IRS isn't grading you on the final score, it's grading you on whether the money showed up on time, each period. Same logic applies to the other thing people get wrong, thinking this only matters if you're fully self-employed. If you've got a W-2 job and you pulled in $28,000 driving, consulting, or selling on Etsy on the side, your employer's withholding is sized for your salary, not your salary plus $28,000. You're in the same safe harbor test as everyone else, and there's a genuinely great workaround there. Withholding is treated as paid evenly across the year no matter when it's actually withheld. So if you have a W-2 in the household, yours or your spouse's, you can bump up Form W-4 withholding in the fall, and the IRS treats that money as if it arrived in April. That single move retroactively fixes a missed Q1 in a way an estimated payment never can. Last piece, and this is the one that separates people who pay quarterly from people who pay quarterly without wanting to throw their laptop. Open a second checking account. Every time a client payment lands, move 30% of it over immediately, before you look at the balance, before you feel rich. That account is not yours. It's the IRS's, you're just holding it. I cover taxes and retirement for self-employed workers, and the number one thing I see is people who did the math perfectly and then spent the money in July. And while that account is sitting there earning nothing, here's the move most freelancers make too late: a solo 401k. For 2026, the employee deferral limit is $24,500 per IRS notice, $25.67, plus $8,000 more if you're 50 or older, and $11,250 instead of $8,000 if you're between 60 and 63. Add the employer profit sharing side, and the total defined contribution ceiling is $72,000. Every dollar you defer there drops your taxable income, which drops the income tax half of your estimated payments. Not the self-employment tax half that's still owed on your net profit, so don't overestimate the savings. But it's the single biggest lever a profitable freelancer has, and setting it up in December instead of March costs people thousands. Whether it beats a SEP IRA for you depends on whether you have employees and how much you actually want to contribute. So the whole playbook, start to finish. Find last year's total tax, multiply by 1.1. If your AGI cleared $150,000, divide by 4. Send it through direct pay on April 15th, June 15th, September 15th, and January 15th, and park 30% of every deposit in a separate account so the money's actually there. That's it. It's a formula, not a forecast. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this made quarterly taxes feel less like a threatening letter and more like a math problem, hit subscribe. I put out this kind of thing regularly, and it's free. If there's a freelance tax question you want me to take apart the same way, leave it in the comments and I'll pull it into a future video. And if your bookkeeping is currently a shoebox and 3 banking apps, the tools I use are linked below. This video may contain affiliate links. I only recommend tools I use personally. Subscribe so you don't miss the next one.